Rates hit the lowest level that we've seen in about a year and price cuts jump. I'll show you the exact payment math and a simple playbook for this week as we open up the weekly real estate debrief. I'm Kev, I'm your local real estate expert, and I'm going to take a full week of housing data and try to boil it down into just a few minutes that you can actually use. I'm going to be talking rates, inventory, winners, losers, a deal breakdown, and a 1-minute playbook that you can actually use to make some moves with confidence. Opening up with our rate radar, we're talking the 30-year fixed average. Over the past 3 weeks, we've seen 6.34 to 6.30 to 6.27 over the last 3 weeks. The 15-year is holding at about 5.5% to 5.6%. This is the most buyer-friendly rate environment that we've seen in roughly about a year. Even the 10-year Treasury has slipped down just below 4% very briefly, and when this happens, you can generally tell that mortgage rates are usually going to catch a bit of a tailwind, but don't expect it to stay that way or to be a straight line because, as we all know, volatility is always a thing. Onto the inventory heat map report. What we're seeing is supply continuing to grind higher. We've seen 23 straight months of year-over-year inventory gains. That means that homes are taking a little longer to sell, and nearly 1 in 5 listings, or 20% of listings, are actually having to do at least one price reduction. This means that the market is starting to nudge a little bit more towards balance. Not a crash, but the leverage is starting to shift. So if you're noticing more price reduced tags, you're not imagining it. This is just the power starting to shift and sort of equalize a little bit. Winners and losers. This week, the winners are any segment that are showing more price reductions and longer days on market. That combination generally means a little bit more negotiating power for the buyer. The losers are anywhere dominated by cash. Roughly 3 and 10 or 30% of all deals are still cash deals. And as you know, cash is king and loves to beat out other normal terms from more conventional buyers. Also, any market that has high insurance friction, like flood zones or any other kind of insurance headwinds, these ones can always cause log jams and put buyers at a disadvantage. Lastly, the 60-second playbook. Buyer, set a rate alert at 6.1%. I believe that if you're able to step into a 6.1% or better on a 30-year fixed mortgage, you're going to be doing really good, and I do believe that it's starting to trend this way. Also, compare any buy-down offers versus points from at least 2 lenders. Next, target homes with 21 days or more days on market and any homes that have had a recent price reduction. Also, sometimes asking for credits sometimes will beat out reducing the sticker price. In cash-heavy markets, focus on offers that have a quick closing and really clean terms. These offers can sometimes really compete with those cash buyers in markets where you otherwise wouldn't have a lot to compete with. Sellers, if you are in a market that has a days on market that tops more than a month, consider about a 1 to 2% price reduction, or even offering some closing cost credits, as sometimes that will actually move the payment for the buyer more than just a small price reduction. Also consider co-marketing with a lender, advertising a temporary buy-down or a payment as low as. Sometimes this converts way better than just a marginal price reduction. Also, when you do adjust your price, a pro tip is refresh the first photo and the headline or the listing description, because click-through rate rules the secondary consumer websites like Zillow, Realtor.com, all of those type of things, just like Google and YouTube. So sometimes this can kind of break you out of a sort of a stagnant listing. So that's it. That's your weekly real estate debriefing from your pal Kev, the local real estate expert. And if you like this video, give it a like and a share. And as always, thanks for watching.